The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gentlemen. Welcome to an SPFC webinar, Standard Bank hosted and SPFC hosted as well. Today we're talking wealth creation, tax savings and retirement goals. We've had the session, but a lot of our customers and our planners missed it. So we're just rerunning it so that we can catch out what Errol said because it was very important and a lot of people found it interesting. My name is Ketiwe. I'm your coordinator for today, but Errol Meyer is going to be your presenter. Just to remind you, Errol is a certified financial planner, an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He has written many tax and financial planning articles and newsletters and study materials for universities and academic journals. He has worked as a tax advocate for SARS and as a legal advisor for corporates. Now, the reason we have Errol here today is because he currently holds the position of head advisory propositions at Standard Bank, which is why we love Errol so much. But before I hand over to Errol, let us do some housekeeping, make sure everybody's on board with what happens during a webinar. If you have questions during the webinar, please don't hesitate to type them in your questions box. That's on your right-hand side. That's on that panel that you see on your screen. There's a questions box. You can type in the question. I will not disturb Errol during the presentation, but afterwards we'll then address the questions for you. Secondly, let's make sure you can all hear me. There's a small high five, a small hand that's on your panel as well on the right-hand side. If you can hear me and can see that first screen, please just click that so that I know we are all happy. Thomas, thank you. I can see your hand. Thank you. Thank you, Tembi, Tanya, Sven, Smith, Sean. Okay, all the hands are coming up. If your sound is soft, please just increase your volume on your taskbar at the bottom. Most people say that the sound is very soft. Just remember to put up that volume on that taskbar at the bottom hand side on the right next to the watch, and then you'll be able to hear us clearly. Okay, so we're ready to start. Errol Meyer sitting and ready. Errol, good afternoon. Good morning, my mistake. Thank you so much for taking the time to join us today.
Thank you. Thank you. Thank you, Ketiwe. Good morning to all of you. We're going to have the session again, and this time you may see a different view for those of you who did attend, where I'm actually sharing my notes with you as well. But I would like you to focus on the main slide because that's the one that we'll be dealing with, and not get distracted by the notes. They for my purposes, and if they are financial planners, you perhaps will find it handy to see how I've done some of my calculations. But I'm simply going to share the conclusions with you during this webinar. So where do we start? We start with the history and the problem statement. It's a slide changing. There we go, there we go. There we go. History and a problem statement. Well, that is actually very simple. Can you retire? They say, stats have shown that many people cannot retire. And that we assume is the age of 65 is the popular one. But I think what one needs to do is to really look at the whole situation and at the concept of retirement. And a good place to start is to look back in history. And they say that the person who designed this concept of retirement is Otto von Bismarck, and that was in 1881. And their people, they simply didn't retire. They had to work. If you live, you work. And in those days, the life expectancy apparently was about 45 years. Well, things have changed ever since, and we know that people actually live longer, which now presents a problem because it is not only about not saving enough, it is whether those retirement funds will be available after the so-called retirement date. Now that especially after the 1960s, after the World War II, that we started dealing with the generation of baby boomers, simply because after World War II, there were a lot of babies born, and many of us are still around, and where you find that they live longer, and it will soon be, people are born now that's going to reach the age of 100. And It doesn't mean, I think also, that at the age of 65-year-old, you're actually younger than in the 1881s. So we have to re-look at the concept perhaps of retirement, because factors such as increased living cost, the fact that kids stay longer at home, the fact that some of the parents actually now needs to be looked after, where the term sandwich generation comes from. All of those factors must be taken into account. So, isn't there perhaps an argument that one should retire or not to be forced to retire at the age of 65, because surely you're still young? So maybe to solve a lot of these problems, it is not impossible that the retirement age could be postponed until a later stage. And I believe there's been some rumors that that will be done to a later stage, perhaps not 70. But why wait for legislation? I mean, when we do our planning, why can't we start re-looking at the concept of retire and say, you know what, perhaps we should make use of other concepts such as like rewiring or putting on new tires, new soles. So what is wrong at the age of 65 to start saving up, not to retire and sit at home with a boat, a dinghy and go fishing, but perhaps to turn that hobby into money? So the whole concept of retirement has changed a lot, and we've got to live up to these times. The fact is, can it become worse? And I think when we say worse is that because a person does not sufficiently cater for the retirement, it is a fact, because we do live in an era of immediate gratification. A bird in hand is worth two in the bush. So therefore, it's not strange that we find that when people need money and they've got funds in their retirement fund, they would try and access that, which is not always easy. And so we encountered many cases where people were actually divorced, not because they want to get divorced or they're upset with one another, but simply if you get divorced, you can actually have access to your retirement fund. And you can make a withdrawal, and you can use that for daily expenses, which increases the problem because we are taking away monies that was earmarked for the future. We also have a lot of people being self-employed, and let's say at the age of 40, they would leave their employment, they will have access to their pension fund, and what would they do? They would invest that in a business, high-risky business, with the hope that they will make lots of money, and therefore their problems will be taken care of. Well, that is not always the solution, but it is a fact that most people will use those funds in order to build their business. And so we find that people are using their retirement funds not for retirement, but for other reasons. How should we go about? What is the solution? Well, I think it is just plain sensible financial planning. We cannot stop people from accessing the funds, but what do you do with those monies? Do you take it? Do you pay off debt? Or do you live a higher lifestyle? And this is where financial planning comes into play. And the retirement planning is a very important part of financial planning. And at Standard Bank, what we do and what the principles that apply is this goals-based financial planning. Now, goals-based financial planning, what it simply says is that you will have certain goals in life. And those goals could be, as you can see on the screen, it would be to retire, it would be to have funds available for education for your child, and some people want to buy a car, or they want to go and they were going to travel and they want to have funds available. Well, sometimes you just can't have it all. And what it means is that you have to prioritize. So the one that I'm going to focus on is the retirement one, given the new concept that I've given to retirement, and say, well, that is a goal that we simply cannot miss. I mean, you don't have to stop working at 65. You can take a staggered retirement. Maybe employees or employers will discover there's a lot of skills lost and a lot of productivity lost. So maybe if one could stagger one's retirement from from your formal employment, maybe a year or 2 or 3 or 4 years, to remain on a consultancy basis with a company until the age of 70 could do a lot. But we're not there yet. So what we have to do is we have to look in the future, identify the goal and say, when do I want to retire? What do I want to do at that day? Bring it back to the present, look into the future, bring it to the present, and quantify it. And this is where financial planning comes in. It is to quantify that amount. How much will I need? I remember years ago that a person, that was about 3 years ago, would take out an endowment policy, put a certain amount away and say, when I'm 60, I will have $1 million. Now, given that in those days, a salary of 30,000 per annum is similar to a salary of 600,000 per annum today, $1 million was a lot of money. But today, $1 million is by way not enough to retire. What the people fail to do is to bring it back to the present and to say, how much do I actually need? And this is what we're going to do in this webinar and show how we go about making use of the tax concessions to calculate how much is needed to retire. So, and this is where the financial planner will come into play, and it would be his job to actually coordinate, to manage, not to be an investment advisor, but to manage the journey to this goal of retirement. And he should be able to offer the following advice. For instance, if someone would come to you and say, I have inherited $1 million. I know that I did not cater for my retirement. What would your advice be? Would you take that R1 million and pop it into a retirement annuity fund and just hope that it's enough? Or can one do a little bit of financial planning, looking at cash flows and looking at tax? Well, the perfect answer, but it will take discipline. The perfect answer would be, if I have a bond of $1 million, repay that bond. If I repay that bond, you should have about 10,000 Rand a month, more or less give and take, available. That 10,000 Rand is an excellent return. Very seldom can any investment, prudent investment, beat that return. So there you see, 10% interest rate, if I take tax of 45% into account, it's an 18% return guaranteed, immaterial of the term. I don't know of any other investment that can do that. But it goes further than that. Now that there's a 10,000 Rand cash flow advantage, what do you do with that? Do you spend that or do you put it away? Now, if one would take that 10,000 Rand and save it into a retirement annuity, you will be subsidized up to the amount of 4,500 because of the 45% tax rate, or whatever your tax rate may be. That means in order to achieve that goal in a very smart way, it's effectively only going to cost you 5,500. So it is true that tax rates went up to 45%, and it is very harsh on the taxpayer. Also, given now what has happened with the downgrade that everyone is talking about, the effect of that is that there could be less disposable income, there could be higher taxes, there could be higher interest rates. So this philosophy of repaying the debt and having the discipline to invest into a retirement annuity is optimizing on all the possible strategies in order to do one thing, to have funds to put away for the retirement. And so that is equally true to other goals, but especially the one in the respect of retirement annuity. Well, that is it from a macro position. So let's take a case study and see how much money is it that I would need, and then what is the actual tax relief. So what I'm going to do, I'm going to look at the scenario up to the age of retirement. That is step one. Then I'm going to look at the scenario step two, at the date of retirement, because there are certain choices that must be made, and there is tax that comes into play because you receive the tax relief for your contributions to a retirement annuity, and that's equally true for pension funds. I don't ignore that. But then once you've made that decision, does it stop there? Is that the end of the road? Nope. It is a new beginning. Because then the real planning starting to take place, and we have to look at the time post-retirement. So there are 3 definite stages that is crucial in this journey where a financial planner must assist you. Okay, so let's do the case study then. Here's an example of a person, age 40, and let us assume, and I'm going to work with this example right through, let's assume he earns 40,000 per month, and he wishes to start planning for his retirement at the age of 65. Now it's quite a long way off, but there's an advantage because we've got time on our side. Once you've got time on your side, with effective diversification, you can actually achieve a very high return on your investment with a minimum risk. So the question is then, first of all, how much must this person save per annum in order to be able to retire? And then, so we're looking for that lump sum. Is it 1 million, 2 million, 10 million, 50 million? And what does it mean? What I said earlier, you have to look into the future and quantify that amount in a present value, because only then can we make meaningful decisions. So we're going to calculate that amount, what is available. And then the second part of the question is, well, if I know how much I must contribute in terms of latest tax legislation, especially after the 1st of March 2016, how great will my tax deduction be? Because the first price is to get a tax deduction for the full contribution. But then there's another question. Can I exceed that amount? Will I be penalized? As in the case with tax-free investments, if you contribute more currently than 33,000, you will be penalized. Is that the same for retirement annuities? Is the same rule applicable? And the answer is no. Even if you would contribute more to a retirement annuity, that is more than what is allowable in terms of the tax break you're going to receive, there are still some advantages and some delayed tax advantages, which I'm going to talk about. So there we go. There's our example. And then I said, how much tax relief is it that this person will qualify, where he's the age of 40, earns 40,000 a month, and he wishes to start planning. So first of all, let us quantify the amount. But what we have to do is for the purpose of this illustration, make certain reasonable assumptions. So first of all, we're going to make the assumption that the inflation rate is 6%. And I saw the stats today released, it's actually 6.2 for the month of February. But that is not too important whether it's 7% or 8%, because each one of us have a different inflation rate. People who have retired may have a higher inflation rate. So whatever is unique to that particular person, you work with that inflation rate. For the purpose of just doing an illustration and to get to some figure, we're going to work with an inflation rate of 6%. Now, reasonable for putting monies into any pension, provident, retirement fund is inflation plus 5 strategy, which means we're going to assume that the growth of this investment is going to be at least 5% higher than inflation, whatever the inflation must be, because that's the target. That is the enemy. We've got to beat the inflation. Once we beat the inflation, then our money is growing. So in this particular instance, also governed by Regulation 28 legislation, we will use then what is often referred to as a moderate investment portfolio. Not too aggressive, not too defensive, but after about 6-7 years, you really will minimize your risk with the maximum returns in such a portfolio. So we decide, for the purpose of the illustration, that the person will need that money until the age of 80. Remember that he's got a spouse, you've got to take that into account. But just for the purpose of the illustration, we're going to assume that at the age of 80, the money is going to run out. So how much then must he save? So there I've done some calculations on the right-hand side. But what is important if we focus on the main slide, is that the capital sum of 1.6 million in today's value is needed. Now I can work with something. If one thing about, if you would look at the calculations on my right-hand side, a present value salary today of 40,000 is about 480,000 per annum. If you're going to look at the age of 65 after 25 years with inflation assumed at 6%, such future salary would be 2 million. It's unthinkable. But I did give you an example that 30 years ago, where a person earned 30,000 rand was a lot of money. So it's going to happen that a monthly salary of 2 million, given inflation at 6%, which makes it very difficult to calculate. So what we have to do is to calculate the amount that is needed at the age of 65. So when you do those calculations, it's a huge amount of about 21 million, 22 million. They can't really work with that. So what we have to do is to quantify it and bring it back to present value. And that's exactly what I did there. So therefore, I know if I have a capital sum today of 1.6 million, I will put it in an investment for 25 years, and it will grow at 11%, which is very reasonable. I would be able to retire with 40,000 per annum from the age of 65 until the age of 80. Now, one can state it differently. If I would sell a second property, and after taxes, capital gains tax, I would receive 1.6 million. I take that money, I invest it, you actually achieved your goal. You just got to wait for the money until the retirement, and you will be able to retire. So if you would receive your bonuses, if you would receive an inheritance or the sale of a second property, an amount of 1.6 million, currently now, put away into a retirement annuity, will achieve and make it possible to retire with a salary of 40,000 or pension per month until the age of 80. But many people don't have those lump sums available. So what he will have to do is contribute on a regular basis. So if you start contributing on a monthly basis, which is about 9,220, and that amount is going to escalate with inflation every year so that we keep pace with inflation and we can afford it, which is very similar to the bond payments I spoke about earlier, and one would put that away, then one would be able to achieve that goal. So there you have it. Very simple. A capital sum today to the value of 1.6 million will take care of the problem in future, failing which it's an amount of 9,220 that is needed today. So what do we then, or what are those tax benefits? So if that is the amount we're going to contribute, will the full amount qualify for a deduction? So let's go to the definition or see the Income Tax Act, what it says about the tax deductions allowable to a pension, provident, or retirement annuity fund. Now remember, it's not to each fund, it's the aggregate. So whether you contribute to a pension, provident, or retirement annuity fund, or only to a retirement annuity fund, it doesn't really matter. Prior to 1st of March 2016, it did matter because different deductions amounts were available. But since the 1st of March 2016, those have fallen away, and you can contribute an amount of 27.5% of your remuneration. Some of you may remember with the retirement annuity, you were limited to 15% of non-retirement funding income. Very much limited. Where now it is 27.5% of remuneration. So let's find out what does the remuneration mean, and let's also look at the practical example. But first, the tax deduction is limited to 27.5% of remuneration or 27.5% of taxable income. That is after you've claimed all your deductions and expenses prior to this one. And then if that amount that you've calculated is more than 350,000, you'll be limited to 350. And this is highly unlikely. Very, very few people make use of that maximum of 350,000. So what we have to do is to calculate 27.5% of remuneration in our case study, which was 40,000 per month, and see how much would he qualify. Recent tax amendments made retrospectively was announced in the beginning of this year, budget speed last year, but effective in this year. And there were uncertainty about certain things. And the question was, if I receive an interest income, which is regarded as a passive income, can I take that into consideration to calculate my contribution to a retirement annuity? Well, if it's above the threshold, the exemption of 23,800, the answer is now very clear, yes, you can do that. But there was another important uncertainty. What if I made a capital gain? For instance, I sold a unit trust for $1 million, and let's say the base cost was 400,000, then 600,000 was a gain. Only 40% is included of that. So you derive at a taxable capital gain. That amount, can I take that into consideration in order to calculate my deduction, which is 27.5? And it's never been clear, but in the explanatory memorandum of SARS, they make it very clear that you can actually do that, which is a huge benefit. That would also include taxable portion of travel allowance. So you can take into consideration just about anything. Obviously, certain ones like dividends, because it is a dividend is exempt, although you pay a dividends withholding tax, cannot be included. And then, if you would contribute more than what you allowed, be it 350,000 or in terms of the 27.5, those disallowed contributions you can carry forward. And if the following tax year you don't actually make a contribution, that will be a deemed contribution that you can get a tax deduction for. With Provident Fund, it's slightly different because of the uncertainty. So on that one, we assume it's only applicable to Provident Fund contributions, because you never could get a tax deduction, but it's only applicable after the 1st of March 2016. So the point is, you can take into consideration just about any income you can think of. And if you would contribute more, you can actually carry it forward to the next year. Okay, so let's go back and see what does it mean to say 27.5% of remuneration. Now, most people who earns a salary or who are employed will fall within this definition. In the past, it was very difficult to do. Now it's very simple. Basically, what you can say is cost to company in simplistic terms. Because remuneration is defined in the fourth schedule, and that includes salaries, leave pay, wages, overtime pay, bonus, gratuities, commission, fees, pension. That means even after retirement, if I would receive a pension, that would be remuneration. So a question we had last time, if I retire, can I still contribute to a retirement annuity? Absolutely. And you may want to. And will you get a tax deduction? Yes, if you had disallowed contributions in the past, that will roll forward. Plus, if you make a contribution, it says very clearly there, a pension. So a pension you receive can be taken into consideration. You will see what is not here is, for instance, dividends, because it's not related to your employer. So you can take everything, just about everything into account. So let's do a practical example and go back to our case study. So here we said our client, he earned 40,000 per month, so that's 480,000 per annum. So his cost to company or his remuneration would be 480,000. 27.5% of that would be 132,000. That is the maximum that he can contribute. Now let us assume, just for purpose of illustration, that he received that million that I spoke about as inheritance. And he puts the lump sum away if he would do that. He would still qualify for a deduction every single year. And that would be for about 12 years, because 132,000 divided, or 1.6 million divided by the 132,000 would be about 12 years. If it was a million, it's slightly less, illustrating the point that you can carry it actually forward. So if you want to put in lump sum and it's more than was allowed deduction, absolutely. You won't get the full tax deduction now, but every year up to 27.5% of your remuneration, you would be able to carry forward, and that will be a deemed deduction. And there I've put it out, set it out on the slide. If a person invested 1.6 as a lump sum, would have been able to deduct 132 per annum, and a maximum tax break can be achieved. The tax deduction will be rolled forward for 12 years. So let us assume that this person now, or a person, receives a salary of 1,500 per annum, argument's sake. But his employer is also contribute towards a pension fund of 150,000. Now this has changed from previous years, especially prior to 1 March 2016, in that the employer, the contribution he's making of 150,000 will be referred to as a fringe benefit. Since a fringe benefit falls into remuneration, it means that your remuneration now would be, and I'll show you the calculation, not 1.5, but 1,650. So we add that contribution by the employer. And 27.5% of that would be 452,000. But remember, we are limited to 350,000. So this shows you it is actually immaterial whether the employer pays or you pay. If the employer would pay a contribution to a pension fund, or even your retirement annuity, if that can be arranged, that would be regarded as a fringe benefit. But the value of that fringe benefit will be deemed to be a contribution by the taxpayer, and he would be able to claim it in his tax returns. The employer, as part of the employment agreement, would also be allowed to claim the payment of the pension fund to the employee as a tax deduction, because simply it is work related. So in this particular instance, the answer would be your gross income is 1.650 million. Your deduction is now limited to 350,000. And interesting enough, the Davis Tax Committee made recommendations it should be increased. So it is possible that in future we may see an increase. So your taxable income is reduced to 1.3 million in this particular instance. That excess amount of 103,750 is rolled forward, as I stated earlier, to the following year and the following year. Or if you don't claim it in the following year, for whatever reason, you may add it to that tax-free lump sum that you will receive at the date of retirement. And let us assume you do not include it in the tax-free portion of the lump sum because you didn't want to take a lump sum. Then all those contributions will be set off as an exemption against your pension. So you can never, ever lose the benefit that you're entitled to. So many people ask, but how do I keep record? Well, with e-filing, it is very clear these days what is disallowed. And one can actually keep track, which was not that easy in the past, because you had to prove to SARS and show which was more, your contribution, which is more than was allowed. Now with e-filing, it is possible to keep record so that that amount is accounted for that you did not receive tax relief on. So let's do an example where the taxable capital gains. Now, what I said earlier, you can claim the maximum of 27.5% of remuneration, and I've dealt with such an example, or taxable income. Now, taxable income would be all your gross income, and that would usually be your self-employed, a person who doesn't belong to a pension or a provident fund. You can take all your income, your gross income, into consideration, you will subtract your exemptions like dividends and the 23,800, for instance, on the interest and what other amounts are exempt. And you will then get to income. You will subtract deductions like business expenditure. And after all those deductions, ignoring this retirement annuity deduction, you will get to taxable income. Once you get to taxable income, you will add on any disposals of a capital nature, like unit trust, that you've made in that particular year. So that would increase your taxable income, and the effect of that is quite often that you're pushed into a very high marginal tax bracket, up to 45%, which leads to the conclusion, in the year that you would sell off unit trust for whatever reason, your taxable income will increase. You may reach the 45% barrier. There is no better time to invest into a retirement annuity, to take away the higher taxes that was imposed on you, to claim back and to claim a deduction effectively at the rate of 45%. So a retirement annuity can quite often be used very wisely from a tax perspective. And to be honest, people have very few tax breaks these days, especially if you are salaried. This is one of them that is actually a huge advantage, given that we all have a goal to retire one day. So let's do an example. Let's assume a person doing part-time work. He doesn't belong to a pension fund, 500,000. He's got funds in a money market of 20,000. And then from the unit trust, let's assume the taxable amount that was included is 100,000 and 100,800 rand. That is after the 40% inclusion rate, and the base cost is taken into account. I didn't do that calculation. I just want to illustrate the principle. So now there are taxable capital gains. What is the maximum tax deduction for a retirement annuity? Well, the answer there on the right-hand side, you'll take the 500,000, because that was gross income. You'll add the capital gains to it. You will note that I did not take the money market into account because it is less than 23,800. That part is exempt. If you had local dividends, even though there's a dividend withholding tax payable, now since the 1st of March 2017 of 20%, it's immaterial. You cannot add that. So you would take 27.5% of the 600,800, and you'll calculate the amount of 165,220. So the taxable capital gain is thus taken into consideration for calculating the maximum retirement annuity tax deduction. Let me just put a caveat to that. If you have no taxable income but only a capital gain, this will not be possible. I didn't do an example of that, so do know that there is a limitation. The rule of thumb is at least receive other taxable income like part-time work, and your capital gain should not exceed that amount. Then one is fairly safe to add that taxable capital gain for the purposes of calculating the retirement deduction. And that settles the part leading up to retirement and the tax deduction that the person is entitled to. Now, what about the date at retirement? So, and here I have seen people making disastrous errors because they are not familiar with the latest tax on the retirement funds. It's been around for about, I think, 7 to 10 years. But for some reason, people still think about the tax-free amount they received in the past. So I'm going to do an example here to show you you've got to be very careful and to see if I can devise some rules, some flags that one has to look out for the day that you retire from your pension fund or from a retirement annuity fund. Here are the facts. A person retired from his pension fund in 2013 and he received a lump sum of $1 million. Now remember the tax rates on the date of retirement. Those tax rates, at that stage you could only have 315,000 tax-free, where today it's 500,000. So in my example, we assume he received a lump sum of $1 million That's now the 1/3 usually of a pension fund or retirement annuity. I'm only dealing with the lump sums here, not with the 2/3 buying the pension fund, only the lump sum. And then, and he paid his tax on that, and I'm going to calculate the tax as if it was 2013. But then now, this is where the advice is important. He's going to retire from a retirement fund in 2016. So the question is, how much tax will you pay? Now, with the retirement annuities, there's a golden rule. If the value in that fund is less than 247,500, you might take the full amount as a lump sum. Because it just doesn't make sense to take a 1/3 and a 2/3. So legislation says, you know what, if it's that amount, just take the lump sum. So in my example, it means that 150,000 can be taken as a lump sum. And people think because he only used up incorrectly 350,000 in 2013, and it's now 500,000, that he's got an amount of about just plus than 150,000 tax-free. And that is not so. Because there's going to be a nasty shock when you receive those funds and you retire and tax will be withheld. Let me explain. And there's the example. Tax-free portion, it used to be 315, which is up to 500,000. So that answer there that shows that 150,000 tax-free, it is not correct. So let us go back to what happened in 2013. And there's no need to go back and calculate it. It is purely for purposes of illustration. If one were to retire now, you don't have to go back and calculate it was in the past. I will actually show you it's quite immaterial. So in 2013, if the guy would have retired, he would have paid the following taxes. It would have amounted to 141,750, and then I go to the tables. And according to those tables in 23, when you do the calculation, what's relevant for us is the actual tax he paid is 161,550. Mistake number one, don't think that those tax that you paid in 2013 is a credit. It is not. So let's see what do I mean by that. If you would now in 2016, remember that's at 150,000 that you can get as a lump sum now, you want to retire from that fund, you know you can get the full amount out. How do I calculate the tax on that? As I said, it is not tax-free. The calculation would be done as follows, and the key word here is aggregation. They take into consideration the previous amount from 2013. They add on the current amount, and they get a total aggregated amount. So they take all pension, all previous funds into consideration, and they will go to the current table and calculate the tax. And you'll see there's some tax relief in the current table that more is available as opposed to the previous year. So the tax that you will pay is 166,500 on the aggregated amount. But what must happen now is that you need to get a credit. Now the credit is not going to be the tax you paid before. The credit is calculated in a kind of a funny way with reference to today's tax tables in 26. And this is how they would calculate the credit. They will take the 1 million and apply it to this year's table, not 2013. And say in this year's table, remember where you get the 500,000, we will take it to the tax tables, and the tax that would be payable is 117,000. So that is the credit that you receive. So how much do you want? It's 166,500 as per my previous slide. Plus your credit is 117,000, not what you paid in 2013. Therefore, your tax would be 49,500 and not as what most people believe it would be tax-free. So 1/3 of your fund will be wiped out by tax simply because the person did not understood the aggregation principle. So let's just sum up the rules. What can we learn from this? At the date of retirement or whenever you retire from a fund, remember you can retire from a pension fund and 2 years later from a retirement annuity, and then 2 or 3 years later from another retirement annuity fund. What is important, first of all, is that that additional 150,000, quite clearly you saw with my calculations, is not tax-free. So here's the caution. If you, for instance, going to withdraw, you want to take a withdrawal benefit from a fund, you've got to think very carefully. Because when you retire from a later fund, it is going to have a very negative impact on the later retirement. Try and postpone that as long as possible. Do what you have to do, but rather retire from both funds than actually taking a withdrawal benefit earlier. It is incorrect to refer to a tax-free portion because this leads to the confusion. That is terminology of the 6-7 years ago that is still carried forward that people tend to remember. So that is not relevant. Prior to the new retirement dispensation, one could talk about the excess portion of being a tax-free, but today we aggregate. Where the total value of the retirement fund is less than 247,500, there are some principles that one has to consider. You cannot do it from the same retirement fund. It's got to be various different funds, and there are some rules. Don't think you're going to get it every single time. You have to do it one with, let's say, the one company and perhaps with another company before that applies. Otherwise, SARS would aggregate the whole amount as well. So the main point that I'm trying to show you is if a withdrawal benefit, and I only spoke about the retirement, withdrawal is worse. In a previous year, then subsequent to the retirement fund, there will be, I call it a penalty. It's actually not a tax penalty, but you will be penalized because of that. Okay, so that concludes our second part. Let's just end off then with the third part. And this is perhaps where financial planning becomes extremely important. Now you have to decide, you've got the lump sum. What do I choose? Do I choose a compulsory annuity that is guaranteed or a living annuity? Now most people choose the living annuity. Why? Because they want access to the capital. They want to manage themselves. Therefore, there's absolutely no surprise that people are running out of funds because it's a lack of financial planning. The guaranteed annuity is a predetermined amount that you will get, usually much lower than a living annuity, but it is a guarantee for the rest of your life. Now, if you would, let's say, go in retirement and you would die after year one, your money is lost, it's gone. But if you would live until the age of 100, you will receive with increases, so it's guaranteed. But many people don't choose for this option because they don't like, they can't bear the idea that their money is lost. They don't get it back. And that is an incorrect way, I would suggest, to think about it. One must, don't think about the money. Think, what is it that I want? I want to be able to have funds available, which I can plan accordingly. That is guaranteed. That's going to increase with inflation. The living annuity one appeals because I can draw down 17.5%. But I can tell you this, if your drawdown is more than 4%, you're going to run into problems. And there are calculations done. So it means if you want to choose the living annuity choice, you've got to manage it. Where in the case with the guaranteed one, that was managed by the employer. So the living annuity on a year-to-year basis, rule number one, to draw as little as possible, but the advantage is if there's leftovers, that could go to a child. But you know what? The issue is retirement. It is you before you start thinking of inheritances. If you want to leave inheritance to a child, give him education, set him up for life. And then if you really want to give him some more money to go and spend, then give him inheritance. But don't take your retirement annuity and base your whole planning whether I should take a compulsory annuity that's guaranteed or a living annuity based on the decision that I want to leave something for my heirs. It just doesn't make sense. And people run into the risk of doing that. So what is important after retirement is to have a competent financial planner, and budgeting and ongoing managing of risk is important. Remember, undeducted contributions may be offset against annuity income. You may still contribute to a retirement annuity and receive the deductions because pension is part of remuneration. After 65, medical aid expenditure can become very relevant, and there are huge, or let's say after the age of 65, there are more tax breaks available for persons after the age of 65, and that would be very relevant when one would choose the level of income if you chose a living annuity. And then remember, interest exemptions after 65 is a bit more than 23,800. Speak on a correction, is 32,000 something, but that exemption is going to diminish in value since they introduced the tax-free investments that you can contribute up to 33,000. The idea was to take away those interest exemptions, but they're still there, but they're not going to be worth a lot in future. Then finally, is it a retirement annuity only then for retirement? No. What if you don't retire? What if you would pass away prior to the date of retirement? Then those funds are available for your beneficiaries. So what I've done here, I've done a comparison between the inter-vivos trust, the discretionary inter-vivos trust that everyone wants to use for tax savings and saving on estate duty, saving on capital gains tax, manipulate the income streams, and that revenue is now since the 1st of March 2017 onto it. And if you would make contributions to such a discretionary trust that's on an interest-free basis, there is some heavy tax avoidance provisions in place. So the trust is losing its popularity. But why did you set up a trust? And the reason is you wanted to protect the funds for the benefit of the beneficiaries in a tax-effective manner. Now, what is a retirement annuity? It is exactly that. A retirement annuity is nothing else than a trust fund. The only difference, if you would contribute to a retirement annuity, you'll get a tax deduction. If you would contribute to an inter-vivos trust, you'll pay donations tax. And if you don't charge interest on a loan account, you will be deemed to have made a donation. With a trust, if you run it smoothly and correctly, which very few people do, you will have those benefits protected. With the retirement annuity, it is protected by law against creditors. And then, from a estate duty point of view, if you would have funds in a retirement annuity, and let's assume it is accumulated to 10 million, all of that will be exempt from estate duty. Not because of a loophole in the Estate Duty Act, because the Estate Duty Act was amended to state that the death benefits from a retirement annuity is exempt from estate duty. And this is why many people set up a discretionary inter-vivos trust to get those benefits. Professor Matthew Lester, which I've spent some time with last year, he often refers to a retirement annuity, and he's very proud of the retirement annuity. And he actually mentioned and he coined it as the poor man's trust. And I tell you what, if you're looking for solving problems and you are considering the discretionary inter-vivos trust in the current tax climate, if for those reasons, look at the retirement annuity. It is a very handy tool for succession planning with all the given tax benefits. For farmers, instead of a usufruct creating for a spouse, her income dependent on whether the son can continue with the farming, by putting monies into a retirement annuity fund, gives her a clean break, don't burden the son, and she's not dependent on income from farming, but she can receive her income in her own right in a tax-effective manner. And that is the end of our presentation. I hope it made sense, and I think, Atiwe, we will take a couple of questions from the attendees.
Okay. So here you go, Errol. The first question is, where should these funds be invested, and are they safe in SA?
Well, first of all, that is not a question that I don't think I'm competent to answer. I don't have a crystal ball. I think your knowledge and mine is exactly the same. But I can tell you that worldwide, retirement funds are very strictly guarded, and you can think of any country, and there's been cases on that. So the last thing that people will touch is the retirement funds, but that is a personal choice by the investor. Perhaps one could ask the question differently. Now the fact that there was there was a downgrade, how will it affect it? Well, that is what the portfolio managers do. As long as you are diversified, then and make sure that you beat the inflation, because ultimately you want to reach your goal, you should be fairly safe. The problem with the downgrade is rather that one will have to make use of the optimum use of tax breaks, the 45%, and if your disposable income is less because it's going to become more expensive to buy milk and bread and stuff like that, you just better make sure better planning or change your risk of retirement. And you, in my example, can't retire with 40,000, it's maybe going to be at 35,000. I think those are the more important issues and the ones that we have control over, as to know which direction we will go. But surely I will still contribute to a retirement community. I have no problem in doing so.
Okay, so that was from Sanjeev. Thank you, Sanjeev. And then from Nina Odhav, she says she has a client who has accumulated pension over 30 years. They've been in marriage for 12 years, currently getting divorced. Lawyer says she should part with 50% of the pension to the spouse. Is this correct? Her view is that they share each other's pension only during the duration of the marriage, so not over the 30 years of marriage.
Okay, first of all, it depends on a lot of factors. This is a divorce matter, but the Divorce Act was amended and the Income Tax Act was amended to make provision, as I spoke to earlier, with people that they divorce, that they can, in the divorce order, arrange the benefit. The fact that it should be 50%, I think it's negotiable, because when this legislation was drafted years, I'm talking about 25 years ago, they started with the pension interest. The whole purpose of this was that there should be a negotiation. It was never to make it part of the assets, but to negotiate, because in those days, the earlier days, the spouse was usually, the wife was usually worse off because she wasn't the breadwinner. That's why it came about. This is escalated now as to the main asset. What is important to me here is not how much I can get and how much I must pay. Financial planning becomes extremely important. So when that divorce order, or you're busy with negotiation, what one should do is have a financial planner, calculate what are your needs. And once you can do that calculation, similarly what I have done, because you're embarking on a new venture now after a divorce, so what you should do is calculate the amount, the clean break, what is needed. Now that could be far more than 50,000 for 50% or less, depending on the other assets. So I wouldn't say it's a rule of thumb. My point would be to make sure that there's some financial planning to calculate how much is needed in order for me to do my financial planning in future.
Okay. And then from Linda Russia, she says, my son is 27 and has no pension or provident fund. His salary is 5,000 Rand. He took out an annuity for 4 years ago and contributes 160 Rand per month. Do you have any advice on how he can plan for the future? He's single.
Okay, well, obviously, if you don't have children yet and you're not married yet, you don't have that much of those responsibilities, which is definitely going to come in your journey, in your lifelong journey. So the fact that he's contributing to a retirement annuity, even though it's a small amount, that is the culture of saving. I like that very much. The effect of compound interest in the long term is going to be astronomical. So whether you should contribute now to the maximum amount of the tax break is not that important to me. It is the fact that he is making a contribution. I would strongly advise that him continue to do so. And it's very seldom that we actually see young people doing that. So yes, you can contribute, whether it's a retirement duty, one day it's a pension fund, or provident fund with his employer, just keep on contributing.
Okay. And then let's see else.
Yes.
There's Haneli. She says, is RA a collective name for living and guaranteed annuities?
No. When you retire from any pension fund or retirement annuity fund, you can take the total sum commuted up to 1/3 as a lump sum. Those were the taxes I spoke about. But the 2/3 that's in that fund, that must be utilized, we say, to purchase an annuity. It's to purchase a pension. Now, whether it's a pension fund or a retirement annuity fund, it doesn't matter. So it's actually a contract that you have with someone that's going to provide you that pension for life. So if it's a living annuity, the difference is still a compulsory annuity, but the difference is that you can decide how much you want, between 2.5 and 17.5%. And if it is a guaranteed one, it's usually provided by the employer. You don't have that flexibility, but you have the guarantee it will be paid for as long as you live. And you even have choices that if I would pass away, that 50% of that would go to my spouse. So there's a whole lot of combinations that one can put together.
Okay, thanks, Errol. Haneli, hope that's good. Then Ursula Fenter says, what is your opinion regarding wealth investments? My husband was advised when retrenched to deposit his pension into a wealth investment. Would a retirement annuity have been a better option?
No, it doesn't matter. I think the wealth investment you're referring to is a preservation fund. So what people do to avoid them taking the money, the industry came up with to establish a fund where you could preserve your benefits. You can't contribute to it more. So you would take your current pension fund and you would transfer it to a preservation fund. It's not a wealth investment. It's a preservation fund. And then you can retire from that preservation fund at a later stage. Now, that preservation fund, whether you call it now retirement annuity or pension fund, the rules are very, very similar in both instances, and which, to my mind, it's a very good idea to do. And that goes to the heart of my first slide, where I say most people will take those funds because they need those monies, and then they will pay the huge tax, the withdrawal benefit tax, and that would be a negative impact for later. So I am fully in agreement to transfer those funds into a preservation fund. Wealth is just maybe a generic term for what was used, but it's not a question whether it's a retirement annuity. What it is in effect a retirement. Operates very similar as a retirement annuity.
Okay. Second last question from Chantal. She says, how do retrenchment bonuses impact your allowable tax benefits?
It does affect it. If you're retrenched, there are certain dates to it. I can't remember offhand the dates. It's about 4 or 5 years ago. If you would take a retrenchment package, and it's approved one, it's not you are a sole director of a company and you decide to retrench yourself. There must be certain rules to those retrenchment. Then that would be aggregated, as I have done in my example. It will be aggregated and it will have an impact on your pension benefits at a later stage.
And then Anissa, she says, I work in the science field, so I earn relatively well, but I struggle to manage my tax returns and deductions. What advice can you give me on that?
Well, I would, to do tax returns, you've got to be a registered tax practitioner and have access to e-filing. As a salaried person, there are very, very few deductions that you can claim except for the retirement annuity one. So what I would suggest is to get hold of a financial planner to assist you with the calculations that I have done to see how much you can contribute, and then find you someone that can do your tax returns. There are professionals out there and they don't charge a lot, and ensure that the contributions that you are contributing towards a retirement annuity is actually being deducted and claimed in your tax return. But that must be done by a tax practitioner. Financial planners don't do that simply because they're not registered as tax practitioners, unless that is part of what they do, but normally we don't find that.
Okay, and then it's another one. It's the last question from Anissa. She says, with regard to choosing the living annuity option, if I to retire and I pass away after, let's say, 5 years, am I correct to say that the money will not pass to any of my relatives? So there's
no, that is the whole purpose of a living annuity, because a person, as I explained earlier with the guaranteed annuity, people opt for the living annuity. And the word living comes from because it lives on. So even if I'm drawing down a living annuity, I can nominate a beneficiary. It doesn't go through your will. You would nominate a beneficiary, and that beneficiary can then continue and receive those funds. And this is where the word living actually comes from.
Okay, there's another one that just came through from Mina. She says,
That's
Oh, that's a text one again. Okay, that's it. Yeah, that's
Some of
it.
the other questions, feel free to discuss it with your financial planner. We have many financial planners that came through my classes, done a CFP, and are well qualified to assist with the calculation of the tax breaks in respect of a retirement annuity.
And for many of the clients as well, you will receive a thank you note with also a link where you can get a financial planner to contact you should you have any further questions for financial planners. Thank you very much, ladies and gentlemen. Session was recorded for our clients. An email will be sent out with the copy of the presentation and where you can get the recording. And for our planners, it is always available to you on the SPFC portal as usual. Errol, thank you very much for taking the time out to do this presentation for us. I hope it was beneficial for everybody. Have a lovely day, everybody, and we'll see you on our next presentation. Goodbye.